Hello out there, John Hardy here with the FX update on this very eventful Wednesday, February 16th. I've titled today's presentation, Whoops, Greenback. We had some serious failure by the dollar to do what it needed to do to convince us here. We've been looking for it to go stronger, especially after the devious little fake we had on the close yesterday. But the action today really, with equity markets heading higher and talk about a discombobulating day. We had also, just to make things spicy in the middle of the day, this crazy situation with Iran sending ships to the Suez Canal and Israeli coming out with its response on the matter. And then that move being wiped away again by equities rushing higher again as we've got another very strong move into the close. I'm here about 52 minutes ahead of New York close. Looks like we're heading for a strong one. And of course, yesterday we were out presenting just as we were at the worst of what turned out to be a very minor sell-off intraday, and then we had some strong Dell earnings out overnight to confuse the picture and make the close less bad yesterday. So we've pretty much gone back into neutral after today's action on the dollar view. We'll get to why in a moment on the charts. Let's briefly head across what we saw today in terms of event risks or news crossing the wires. Overnight, we had Moody's reminding the market of its negative watch on some Australian banks. Market, absolutely no reaction to this, but this is a very, very, very key thing to worry about for the future. It's all about these reinsurance companies. I mean, it's just a carbon copy of what we had in the U.S. The setup is so similar now. The negative outlook related to reinsurance of securitized this, that, and the other, and about banks that are issuing securities. And it couldn't be more of an echo of the U.S. subprime debacle if we had tried to make it up from full cloth. And what it's going to mean is once the housing bubble in Australia pops, this is going to come unwound in a similar fashion to the U.S. Maybe not as cataclysmic, obviously, for global markets because it's a smaller market. It's not the contagion risk isn't there, but the country-specific risk in Australia is quite large. Alas, the traders don't care. If equities are up, the Aussie's up, and that's all we need to care about according to the market. We should recognize that. And sorry, I just switched off the screen from you there, having a look at a couple other things here. And we even had a strong sell-off in copper intraday. That's coming off here toward the end of the day in the U.S. So Aussie not getting as much pressure as one would have thought midday from the copper prices selling off. And with the big rally in Aussie, it's looking like it does not want to sell off for now. And again, we've headed to neutral on that one. We'll get to the charts in a moment there. Elsewhere, Bank of England inflation report was out. Bank of England making it clear that it's going to be dragged kicking and screaming into any rate increases. King really trying to underline that he hates the idea of pre-announcement of rate increases, and the inflation report reminding how much the bank is fretting the degree to which austerity could affect economic growth. So basically we had a very, very pumped view on where the UK is going rate-wise, and this article tried to throw a little bit of cold water, or not article, but this report tried to throw a bit of cold water on that. And it succeeded to the extent of about 65 pips in euro sterling. Intraday, of course, with the dollar, when the dollar was stronger, we had cable all the way below 160. But with the dollar wipeout later in the day, that's back much higher again, towards almost towards 161 now as I'm speaking. And this is confusing the euro sterling picture a bit. And again, if we're going to move into a pro-risk environment, which the market is trying to do at the moment, the sterling tends to underperform a little bit. U.S. data. Core PPI was way, way high, 0.5% versus much lower expected. And this very high level, for a while anyway, had bonds selling off. I got a bit too excited on the dollar Swiss picture. If you were following my Twitter stream earlier, as you remember, I said dollar Swiss parity, here we come. We had a pretty interesting dollar picture shaping up. But then, again, with the risk exploding to the upside and the dollar coming off, we've had to neutralize the view on that one. Although I did mention yesterday about Euro Swiss and the gut feeling that perhaps if bonds and interest rates find some pressure to the downside, we could see Euro Swiss breaking back below that 130.70. That did happen today. We did see bunds coming into this morning. We saw bunds a lot higher, and we're seeing a bit of a Euro Swiss reversal. So the bulls in Euro Swiss need to prove themselves at this point, looking at that cross. Elsewhere, U.S. housing starts, building permits. We had a somewhat misleadingly strong housing starts number. We also have to remember the weather effects here for the U.S., but as well, the strong housing starts being in multi-unit housing, that meaning apartment buildings, because people can no longer afford to buy houses, I guess, and are looking to downscale their existence, what have you. This is not as bullish as it looks. Building permits were still very, very weak. And that's a bit of a concern because building permits obviously live a little bit less weather affected than actual starts. So we'll follow that. But basically there is no housing market rebound in the U.S. that's interesting for a long time now. We have the risk of the unwinding of the GSEs, etc. So even if we see starts and the overall volume begin to increase slowly, rising costs, rising interest rates are going to mean and more of a free market rather than a government subsidized market, which is what we have right now. We're going to see lower prices on housing. Risk on, risk off. What did we change direction about 3 times today? We had some good earnings pushing it to the upside. Then we had the Iranian situation, Iranian Navy or ships situation, and then the market decided to get over that. So again, a really discombobulating day on the charts. FOMC minutes came out with very little to discuss, not much in the way of fanfare there. Greater confidence that the economy is growing. Inflation remaining subdued was the view. Household spending, looks better, but is it sustainable was the question. There was this odd expression of there's not much inflation worry now, but some bizarre worry that once companies decided that they had pricing power, they might suddenly raise prices in a gap-like fashion. That seems to be a weird way of expressing yourself in the minutes, but that was a bit interesting, about the only sign of inflation where we could get out of those minutes. And then there's an interesting discussion of the public concern over the Fed's balance sheet and whether it had the wherewithal to withdraw liquidity when the time came. And the unanimous that the rate decision or the policy statement decision was unanimous. So not a whole lot to go on. We had an attempt for in the STIRS market to sell off a little bit for rates to head a little bit higher, but that was wiped out. We're back to neutral on that front. Interestingly, with Eurodollar trading higher, a little bit higher though on the day, the spread actually went the other way, and it's interesting to see that we're not paying any attention to interest rate spreads today. So a divergence there that's rather interesting. Looking ahead, we wonder what happened to our U.S. ABC Weekly Confidence Survey. We talked about this the other day. It never came out. If anybody knows why or can locate that, I was unable to do so. Maybe they just skipped a week. I don't know. But we were interested in seeing the results there. In Asia, we'll have the RBA's low out speaking. Tomorrow, Swedish CPI. And the U.S. CPI, big focus on the core there. At some point, with all these higher prices in the economy, we can't. There's only so much you can lie about the inflation figures, even in the U.S. So maybe the PPI leads the CPI a bit here, but at one point does the ex-food stuff or the core CPI begin to rise as well and trigger the view that the Fed has to ease off on the quantitative easing. Jobless claims, very interesting every week now. Though still, unfortunately, with all the weather effects, we have to wait, I think, till March time frame before we have a better bead on jobless claims. We had a horrible number 2 weeks ago and then a very good number last week, so that evens out to basically a flat trend of around 400 or slightly plus. Philly Fed also out. That's the second of the major manufacturing surveys. And Bernanke will testify on Dodd-Frank. And interestingly, Fed's Fisher out speaking. He was out speaking yesterday. I sent a link out on Twitter where he was basically saying the first step for withdrawing liquidity isn't necessarily the interest rate mechanism. It's selling treasuries, and that he suggested that he would be the first one to want to move on that because he sees himself as ahead of his colleagues. Well, of course we do too, and so does the rest of the market. I think this guy is a rather clever fellow, and he's interesting to watch. And he could become the next Hoenig on the Fed in terms of a dissenting voice if the Fed tries to make suggestions of QE3 at some point. Okay, to the charts. Again, pretty decisive day or indecisive day. with two-way movements, really confusing. It doesn't look like so much on the daily chart. Basically, it is a bit disappointing for the bears here that we're back out of this zone between the two support levels and have come back up here. If we look at a shorter term chart, we had a really nice reversal off the attempted new highs above this key resistance line here, very sharp sell-off, and then a massive rally that was initially triggered by absolutely nothing. So sometimes when you have something that happens with no sign of why, that should really give you extra pause. Euro sterling higher on the Bank of England inflation report. That messes up the immediate signs that we're going to continue lower with this low not holding here. But still, if we expect it higher, we need to see those moving averages give way again. And so far, the 200-day is holding Euro sterling. Euro Swiss, disappointing for bulls there that we've slipped back below this 130.70 area, and that's the key resistance now as we look lower, possibly for retest of the 55-day. We'll keep an eye out. I think to encourage that view, we'll need to see interest rates continuing to come off. I think Swiss franc is very sensitive on that account. Dollar Swiss, we had a bad fake out on that one, similar to euro dollar, with an acceleration here and then a reversal, a nasty reversal as the dollar weakened across the board. Yen crosses, again, I would say euro yen. That's interesting. Actually, here towards the close, it's coming off a bit more. It is pressured a bit by this rally in bunds. If that rally sticks, we could expect the range to hold. And dollar yen, a bit ugly on the day. The new highs on this 83.69, not quite holding here. We haven't really cut deeper, and we have had an awful good run. So the bigger support level being the 55-day moving average. Dollar Canada back lower towards the 3-day lows. And you would expect it if oil continues higher from here and risk appetite remains gunning higher. And hey, we had Laszlo Barinier out on CNBC today saying we're going to get to what was it 2850 in the S&P by September of either 12 or 13. So if you believe that, boy, we're going to see dollar Canada down at 80 at some point. Regardless, it looks heavy. 99 is the key resistance area. Look at that, 3 days in a row of that holding that area. On Aussie dollar, bad fake out yesterday. We had the momentum, rather good momentum sell-off yesterday. Looked like it was set up for some bigger declines. But again, risk appetite, it's hard to believe in an continued Aussie sell-off when we're seeing upside in equities. So the reversal there is rather interesting. But we stay in a range unless we take out 10058, which is the weekly pivot, and then 101, the figure, plus a little bit. Getting above there, you're looking at a full retest, and who knows what to the upside if equities continue towards, let's say, 1350 plus in the S&P. Cable, intraday, if we had closed back at 160, it would have been a very bearish setup, as we talked about earlier, but it didn't. Dollar sold off. That keeps the range intact for now, even though, again, interest rate spread-wise suggests we should be pressuring the downside more. So interesting to see this divergence in the action versus what the spreads are telling us. Euro Stocky with pro-risk coming back in vogue today. Euro Stocky has lower, no big surprise there. And interestingly, on the emerging market front, we've been seeing a lot of pressure on the emerging market spreads, suggesting a bit of risk aversion in EM land. That's not evident with the day like today. We got a pretty big sell-off in many of the emerging market pairs, so we would need to see that reversed to get confirmation that EM risk appetite is coming off as well. Basically, a day with a lot of confusion, two-way action. It neutralizes our view. We're not willing to switch it around just yet and say the dollar is going to collapse. Just that this messy action takes away the momentum from the stronger dollar view, and we will neutralize our bias for the time being. Let's see what tomorrow brings. And whatever you do, stay careful out there, and we'll be back with you tomorrow. Have a good one. Over and out.